So we're going to get started here. Welcome, everybody. Hi, Erin. We are here. Hi, Erin. So welcome, everybody. We are here on our webinar. This is being recorded, so if you don't want to turn on your camera and be in perpetuity on the internet and all that stuff, you can choose to leave it off. My name is Faramarz Moeen Ziai. Everybody calls me FM. I am the branch manager of the Berkeley office of CrossCountry Mortgage. I'm joined here with Meagan Harris from Golden State Finance Authority and Erin George. And we're here to talk about an exciting program called Recover California Homebuyer Assistance from GSFA, where Meagan works. And it's up to $350,000 of down payment assistance for people who lived in the areas that were most affected by fires in 2018 and 2020. And if you live in the house for 5 years, you don't have to pay it back. But I don't want to steal her thunder. She's going to be going through the overview and everything and running through the program. On this meeting, we're going to go through the program overview. Meagan's going to walk us through that, and then I'm going to get just not too deep because I figure everybody's lending guidelines, it's kind of tailored for them, but we're going to talk about some of the income limits and give a couple of examples of some purchase prices. And then Erin is going to walk us through some listings in the eligible areas that are within that price range where someone who fits in that in those income limits can use that 350 to also get into those areas. So without further ado, program overview. Meagan Harris. Meagan and I have been presenters together on the California Association of Realtors STEPS webinar series. That's how I got to know her. She's a wealth of information, super smart, very approachable, knows everything about these programs. And if you want, Meagan, I'm going to stop sharing my screen if you want to share yours.
Yes. Thank you, FM. So we're going to go ahead and get started here on the presentation piece. Again, I'm Meagan Harris with Golden State Finance Authority. I'm the program administrator there. And I'm so happy you guys are all taking time out of your lovely Wednesday evening to learn about this program. It's exciting. We're excited about it, and I'm happy to share this information with you. So before we jump into the content, I just want to share a little bit about GSFA, who we are and what we do. GSFA stands for Golden State Finance Authority, and we are a housing finance agency. And our business is primarily to improve affordability when it comes to homeownership for Californians. And we do that through enhancing traditional mortgage loans with down payment and closing cost assistance programs. So far, we've been in business for over 31 years, helping over 85,700 families and home buyers with over $664 million in down payment assistance. So with this program, it's a little bit different than what we ordinarily offer. First and foremost, it's provided by the California Department of Housing and Community Development, also known as HCD, and it's funded through a community development block grant for disaster recovery from HUD. And so GSFA is essentially the program manager or administrator for the program. And obviously with our background and experience, we're well poised to do that. So I'm going to talk to you today about the program features, as well as how to get qualified for the program, and then what it takes to get started. So the Recover California Homebuyer Assistance Program is primarily for low to moderate income households that were impacted by wildfires in 2018 and 2020. And the assistance provides up to $350,000 per household, as FM pointed out. And the idea here is to help people establish sustainable home ownership outside of a high-risk fire area. And so, there's reasons why we care about homeownership, right? I mean, the benefits are endless. Aside from it being the American dream, it's been shown to have a proven positive impact on not only families, but communities at large. Homeownership tends to improve stability in neighborhoods, increase educational achievement, as well as civic engagement, and can even improve the physical and psychological health of individuals and families, because when you don't have the stress of worrying about the stability of your home life, other things tend to go a little bit smoother, right? And then, of course, crime reduction is lessened or improved, if you will, with home ownership. As people have a tangible investment in their communities, they're more likely to care and take an active role in how the neighborhood and their communities operate, and just want to have more of a vigilant position in terms of protecting the integrity of their communities. And then, of course, we can't ignore the financial benefits of homeownership, right? If we talk about net worth, for example, most people, when we're having a conversation about wealth, we can't overlook real estate, right? The vast majority of wealthy individuals have real estate in their investment portfolios or just overall wealth profile. And so, according to the Federal Reserve 2022 survey of consumer finances, the median homeowner has a net worth that of 38 times more than a non-homeowner. So to put that in dollars and cents, we're talking about $396,000 over someone who doesn't own a home, who may have a net worth somewhere in the neighborhood of $10,400. So vast difference there. So I want to talk to you about the home buyer assistance and how it's structured. And I'm going to be referring to the assistance as HBA, home buyer assistance. It's used interchangeably with DPA, which is down payment assistance, but this is such a larger scale program that has a bigger impact. And so we want to emphasize the fact that it's an overall assistance for people who are looking to get into homeownership, or if you've already been in homeownership, how to reestablish homeownership in a different area. So the assistance provides up to $350,000, and it's provided as a forgivable second mortgage. The second mortgage has a 5-year term and no interest. So that's a 0% interest rate. There's no monthly payments, and there's no interest that will accrue on that $350,000. Also, the assistance is forgiven completely after 5 years, as long as you occupy the property as your primary residence for that 5-year duration. And it's not an all or nothing deal. It's actually forgiven at a prorated basis of 20% per year that the homeowner occupies the property as a primary residence. And of course, in the event that you have to vacate the property for whatever reason and decide to rent it out, there will be a recall on any unforgiven portion of the assistance. And there's always going to be exceptions to that. And we'll evaluate that on a case-by-case basis. But basically, when you enter into this program, you want to have a long-term range on your intention to remain in that property. And so the assistance itself can be used for a variety of expenses when it comes to purchasing a home, primarily down payment and closing costs, as well as prepaids, and any ordinary or customary expense associated with purchasing a home. It also covers your home buyer education fees, and home buyer education is going to be a key component of qualifying and receiving the assistance from the program. We've negotiated a rate with eHome America to make the home ownership courses more affordable. However, the assistance will cover that fee as well. And so this is going to be a high-level overview of what the process will look like. This is very high level, by the way, more like a 30,000-foot view. But this is to give you a general idea of what to expect. So first and foremost, you want to partner with one of our participating lenders. And FM is definitely one of our participating lenders. He's very knowledgeable and experienced and can offer you explanations and definitions, as well as pricing, interest rates, etc., on the program. So once the eligibility is established, you can proceed with moving forward in the process. But let's talk about eligibility and what that looks like. So first and foremost, this program is available to people who were either renting or owned a home in a high or very high fire hazard severity zone in one of the eligible counties. We're talking about Sonoma County this time, and Sonoma County is eligible for the year 2020. So if you lived in Sonoma County in 2020, you may be eligible if your address was located in a high or very high fire hazard severity zone.
Megan, I think this is really important to hammer home for folks, is that it's not just, some people automatically think that you had to have a home that burned. This is not disaster assistance if your house burned. You just had to be living there And what was interesting was you pointed out to me, you could even be living rent free. You could be living at your parents' house or own a home there at that time or renting an apartment as long as you just lived in one of those areas, but you didn't necessarily have to be impacted by the fire, right?
I'm glad you pointed that out, FM, because that's absolutely relevant. A lot of people think that they had to have been evacuated or had to have their property destroyed in order to qualify for the program, and that's not the case. You also don't have to have been a renter. We have kids who were living at home, 16, 17 years old in 2020, and now they're of age and they want to be homeowners now, right? And this is their gateway into entering into homeownership. And so, again, it's important to emphasize that you don't have to have had a disaster impact you, but if you are in an area where it's likely to happen based on, or not necessarily likely, but it's zoned for a high or high fire hazard severity area, then you could be eligible for the program. So with that, once that's established, your lender is going to qualify you for the max home loan amount that you can afford. So aside from the assistance, how much of a home loan can you afford with no assistance at all? And they're going to qualify you based on that. And here's some eligibility criteria in terms of the first mortgage. So first and foremost, this program is for purchase loans only. And GSFA sets the interest rates for the program. And the loans that we have available, the mortgage loans, are going to be FHA, VA, USDA, as well as conventional financing. The loan limit for the program is $766,550. That's the base loan amount, and your lender can help you define what base means versus your total loan amount. And if your county or loan type limit is lower than ours, then that lower limit would be the prevailing maximum. The household income limit. So this is another key factor of qualifying for the program. So any adult living in the household who earns a regular income, whether they're going on the loan or not, their income would also factor into whether or not you qualify for the program. And we have the income limits here defined by HUD. It's going to be at or below 80% AMI. And it's also going to be based on the county where the subject property is located. And AMI just stands for area median income. And really quickly, we're going to head over to the income limits page provided by HUD. And so this is what your lender is going to use to determine whether or not your household income fits within the parameters of the program. So if we were to, by the way, even though you lived in Sonoma County in 2020, you don't even have to live there now. But if you lived there in 2020 and it was in a high impacted, fire area, then you could qualify for the program. That being said, you don't have to remain in Sonoma County. Of course, we don't want to depopulate areas, but it's up to you to decide what's best for you and your family. But let's just say that you were deciding, you live in Sonoma County now, or you lived there in 2020, and you want to remain in Sonoma County. So in that case, we would choose Sonoma County as the basis for the income limits, because again, the income limit is going to be based on where the property itself is located. So we'll click on View County Calculations. And then we're going to focus on this number here at the bottom where it says low 80% income limits. And so as we can see here, this is going to be based on the number of people in the family that'll be occupying the home. So for example, in Sonoma County, that's where you're purchasing the property. If you're a one-person household, then your income limit would be $77,500. If you are a couple, right, the income limit would be $88,600. Or maybe you're a single person and you have 5 kids, right? We're going to come over to the 6-person column, and we can see here that the income limit there is $128,458 or $450. And so again, your lender is going to help determine that, and you're going to go through a process with them that'll help make things clear for you as you're moving through the program. And you don't have to have perfect credit to use this program. The minimum credit score is 640, which is pretty reasonable. If you're purchasing a manufactured home, the minimum credit score would be 660. And we have a minimum and a maximum debt to income ratio requirement for the program. And for those of you who don't know, the debt to income ratio is the metric the lender uses to measure your income against your debts. to help determine how much of a home loan you can afford. And this program is need-based. So that's why we have a maximum and a minimum debt to income ratio, because the minimum debt to income ratio establishes your need, and the maximum debt to income ratio establishes the affordability. Okay. And so the minimum debt to income ratio is 42%, and the maximum debt to income ratio is 45%. And so ideally, we're recommending lenders qualify you somewhere in the middle, like around 43.5%. So that way, if there are any changes in the figures along the way of making your loan, it's not going to knock you out of qualifying, because you do have to stay within 42 to 45% on the debt to income ratio in order to remain eligible for the program. And as I mentioned, homebuyer education is a core component of eligibility here with the program. At least one borrower has to complete it. And it is going to be an 8-hour online course along with a one-on-one counseling session. And again, funds from the program can be used to cover that expense. This brings us to the third phase, if you will, of the process in the program, which is estimating the amount of assistance you'll get. And to do that, your lender is simply going to take the value of the property or the purchase price, whichever is less. They're going to subtract the amount of home loan that you can afford from that amount. And then they're going to add the closing costs and prepaids to that. And the closing costs are simply the fees that are associated with making a home loan and purchasing a property. And then they're going to subtract the greater of the duplication of benefits or liquid assets over $100,000. Duplication of benefits are simply benefits that you received from, say, FEMA or some other federal entity for housing assistance as a result of that same disaster. So let's say you received $100,000 from FEMA as a result of that fire. And if you have any of those funds left, that would count against the amount of assistance you would get. However, if you have liquid assets over $100,000, anything over $100,000 would also count against, but we're going to take the greater of those two numbers. So it's not going to be both. So for example, you got $100,000 from FEMA, but it's been 4 years, you don't have any of that money left, but you also have $110,000 in liquid assets. We're going to take that $10,000 that you have over the 100 and subtract the benefit by that $10,000, and that would be your contribution to the transaction. So instead of the $350,000, you would be getting $340,000. And so that's how we would arrive at the calculation of how much assistance you would get from the program. And this slide is just an example of various scenarios that represent different home buyers and what their situation might be. So it's all going to be based on a $600,000 home price and then the max mortgage loan amount that they can afford. So for example, in scenario 1, the home buyer can only afford a $400,000 home loan. Scenario 3, the borrower can afford a $150,000 home loan, right? So as we can see here, there's a lot of variation between what you can afford and of course the cost of the property. And so we essentially subtract the down payment required plus any duplicate benefits you've received or assets over 100,000, whichever is more, and then we would then be able to arrive at the final amount of assistance you would receive, as well as your contribution as applicable. So once you get the estimated amount of assistance you're going to get from the program, that's when you can start looking for a property. And this is important because a lot of people tend to team up with a realtor first without actually knowing how much they're pre-qualified for, if they're pre-qualified at all. And so that's why it's important to not just be a window shopper when you're purchasing a home. You want to be in a position of power and a legitimate position of negotiation, right? Because you know how much money you have to work with and you have a credible offer to submit to your seller, and you're not wasting your time, your realtor's time, or anyone else's for that matter. So you locate your property, and there's also going to be some qualifying criteria for the property select. So first and foremost, the property does have to be owner occupied, as I pointed out before. And then it's also going to be a limitation, if you will, of what kind of property you can choose. And the limitations are actually pretty reasonable, right? You can choose a single family residence, and that property can have an ADU on it, an accessory dwelling unit, which is like a granny's quarters or some other additional structure on the property that can be inhabited by another occupant. You can also finance a condo using the program, a townhome or a PUD, as well as a manufactured home, which tend to be in the more affordable range. The properties that you can't finance under the program are going to be 2 to 4 unit properties, co-ops, as well as investment, second, and vacation homes. So you want to keep that in mind. Another key element of the property is that it must be located outside of a high or very high fire hazard severity zone. And there's no guesswork there. You know, unfortunately, there were so many people that were impacted by wildfires in 2020 and 2018 alike. And there were people who were maybe near a fire, right? And they're questioning whether or not their property is eligible, or they may be assuming that their property is eligible because they were near a high or high risk area, or because they were near an actual wildfire. But we've taken the guesswork out of it for you and provided this link that is going to be used for 2 purposes. The first purpose is going to be to determine that your original property that you resided in 2020 was located in a high or very high risk area for wildfires. The second reason we're going to use this link is to determine that the new property is not located in a high risk area. So let's go ahead and click on this link. Okay, and this link is provided by CAL FIRE. And what CAL FIRE is doing for us here is helping us define those high risk areas as well as the low risk areas. They have a key here on the side, a color coded key to help us define what those areas will be. So if it's pink or orange, it's going to be very high or high. And red is also very high. Any other color is not, okay? And so what we're going to do here is click on this little hourglass or looking glass thing here, and we're going to type in an address. So right now I'm going to use an example of what our original property was, right, where it was located. So let's see. We're going to type in the address of our original property. Okay, so I just pulled up a property address in Paradise, California, and it's pulling up red. Okay, and this is important because it's not just enough to be located in the county. You also have to have an address that was located in a pink, orange, or red area. And so as we can see, this property was located in a high risk area because when we typed in the address, it pulled up red, okay? Now we want to make sure that the new property is not located in a high risk area. So we're going to go ahead and type in the property address for the new property that we're purchasing. And as we can see here, it's gray. So that's not pink, orange, or red, which means we're good to go. It's not in a high fire risk severity zone. The other element of the program and the property qualifying is that it's able to be insured by a traditional homeowners insurance policy. You know, I'm sure a lot of us have heard about insurance carriers bailing on California because of the wildfire crisis. And for those of us who are able to get insured, we might have extremely high premiums. And so we want to keep affordability at the center of the program. We want to make sure that your mortgage loan payment and your insurance is affordable over a long period of time. So with that being said, we do require that the property is insured by traditional homeowners insurance. California Fair Plan, which is an alternative plan for folks who may live in a higher risk area, who can't get traditional insurance, are not going to be allowed on the program, nor are there companion policies. Another element of the property qualifying is a minimum and maximum number of bedrooms according to the number of people who will live in the property. And so this is going to be defined by HUD and on a basis of 1.5 persons per bedroom per household. So for example, if you're a single person and you're using the program, No one else lives with you. It's going to be one person household will have a maximum or minimum number of bedrooms of one and a maximum number of bedrooms of two. If you're a single person and you have 4 kids, that's 5 people in the house. Minimum number of bedrooms is 4. Maximum number of bedrooms is 5. And so I wanted to show an example of the difference the assistance can make for a home buyer using this program. You know, home ownership, unfortunately, is out of reach for so many people in California. Affordability is just unrealistic or unattainable for a lot of folks. And so we want to change that using this program, particularly for folks who are impacted or in a high risk area for impact by wildfire. So let's say you can only afford a $268,000 home loan, but all the homes in your area or where you're looking are in the neighborhood of 600,000. Okay. If you were to qualify for the full $350,000 in assistance from this program, you would have $332,000 to close the gap between what you can afford and the price of the property. And not only that, you would have the $18,000 left here to help you with your closing costs. So this is going to be a program that's going to go a long way in closing that affordability gap for you. Essentially, you'll have a $600,000 home with a $268,000 mortgage. And again, this assistance here is forgivable, right? So that positions you to have a great deal of equity in the property as well, which is a win for everyone. So how to get started? So the main thing you want to do when you want to get started on this program is reach out to a participating lender. As I mentioned before, FM is one of our participating lenders, as is his company. And this is important because they've been approved to use the program. They've been trained on the program, so they understand the guidelines. And whatever they don't understand, they have access to the information to find out. So they're going to explain all the policies to you, as well as the eligibility requirements, interest rates, etc. They're going to calculate that assistance for you so you have an understanding and an idea of what you have to work with when it's time for you to purchase your home. They're also going to take care of your application for the assistance, as well as your home loan. So at no point in time will you be working directly with GSFA. It's a simple transaction where you'll be able to work with your lender from start to finish.
We like working with GSFA. That's not a terrible thing.
Obviously, right? So again, you know, the idea here is to establish long-term housing outside of a high-risk area for wildfires. And no one has a crystal ball and is able to predict the future. You know, we've seen some areas that were considered low risk recently, and they were impacted by wildfire, right? And so what we're trying to do here is our best to mitigate that risk. But again, nature and unfortunately human error have a way of, you know, making things unpredictable. But we want to position you to use this program and get the most of it to at least put yourself on the path to being out of the way when it comes to wildfires. So with that, I'm going to stop sharing my screen and turn it back over to FM.
Meagan, that was amazing. Thank you so much. And you completely stole all the thunder out of the rest of the presentation, because I was just going to cover all the stuff that you just already covered. So that's fantastic. Thorough as always. So yeah, again, take a look here. This is the key. Income limits, Sonoma County. It's this box here based on who's here. We also, Erin also covers Napa as well. So Napa County, a little bit higher on the limits here. Now, this is so powerful because I work with a lot of people in that 80% low to moderate income who are limited to what you basically see in this loan amount row right here. Oops. And let me get my little highlighter here, laser pointer. They're limited to these numbers here, but now all of a sudden your purchase price, and these are the kind of numbers for that one household, 2, 3, 4 household. If we reverse engineer those debt to income ratio numbers that Meagan was talking about, all of a sudden somebody who was capped at a $460,000 loan with a family of 4 can go all the way to $800,000 and have all your closing costs covered. Look at the cash to close down here. It's almost zero. and it can be zero. So literally all that money is coming from the state. And if you live there for 5 years, that is just equity that's been given to you by GSFA right there. So that's really incredible. Monthly payments that are affordable, house prices that get you into something really nice. So now I'm going to kick it over to, let me see, Miss Erin. So Erin, here are some sample listings that you sent over. So these are active live on the market right now, right? And there's some that are touching each one of these price points here. Erin's a fantastic realtor up at Sotheby's in Sonoma. She covers Napa, Sonoma, Santa Rosa. And just real quick, that fire severity map, if you look at it here, I'm zoomed in on Santa Rosa. So if we zoom out a little and zoom back in, you can see that the entire downtown area, Sebastopol, Santa Rosa, down to Rohnert Park, all this stretch on 101 is all gray. So if you happen to have lived in the hills up in these areas here in 2020 and are coming down to purchase a home here, these are all eligible. And all of Erin's sample listings are from areas that are eligible for this program. So you want to walk us through these?
I do. And first, I just wanted to thank you for putting this together. It's really
Oh,
exciting
sure.
to see so many faces ready to explore the wonderful world of homeownership. I'd like to be your guide as we dive into some of these fantastic properties that do qualify for the $350,000 home buyer assistance. And I just wanted to also illustrate too, you might be wondering, why is this such a great time to be a buyer? Well, let me tell you, this program opens up an incredible opportunity for you to own a home with financial support that can make a significant difference in your purchasing power. Whether you're a first-time home buyer or looking to upgrade, this assistance can really help you achieve the dream of homeownership sooner than you ever may have thought possible. So let's jump into showcasing some of these homes that not only meet the program's criteria, but also offer great value and potential for your future. With interest rates stabilizing and the market becoming more favorable, you really have a unique opportunity at this point in time to make a wise investment for your future. So please feel free to follow up with any questions, engage throughout our session here. We're here to help you navigate this very exciting journey and help you find your next home. So this first one in Rohnert Park on Lombard Way, 4-bedroom, 2-bath, 1,546 square feet, not too far from Sonoma State. Great home with some nice upgrades, nice big lot that you can see there, that you can have the advantage of dreaming what you want to dream here. Somewhere for somebody to run around, kids, your dogs, plantings for a garden, a pool maybe someday as well. So Rohnert Park, as most of you, I would imagine if you're familiar with Sonoma, is a great community, local restaurants, center into the county itself, as far as Sonoma County. So we can move on to the next property. Then we've got Leilani Court in Santa Rosa, priced at $735, 3-bedroom, 2-bath, almost 1,900 square feet. Very sweet neighborhood, 2-story home. And again, I selected the ones that should be relatively turnkey for you to be entering as well, so that you're not having to move into a property and also put in a lot of extra money into the property. Let's realize instant equity with the programs that we have here. And then we've got the 109 Creek Way in Santa Rosa, 777,000, 4-bedroom, 2-bath, almost 1,900 square feet. And again, you can tell from the pictures, some nice upgrades. Should be easy for you to move in and really start to unpack and enjoy living your life.
This
Knowing
is amazing because this all of a sudden opens up something where somebody's price point would have been 450 and now they're jumping up into this 800 zone. And this is completely, what's the difference between those two classes of homes, either in terms of neighborhood or size or anything like that, going from 450 to 800?
Oh, I mean, you're looking at much more. Once you move up into the price points, you're finding that you've got, for the most part, more of an owner-occupied neighborhood. Something to be said about living where people have established roots, that
Yeah.
they are really engaged in the community as well. So what a difference. But no
Yeah.
matter what, the opportunity to get into a property with some instant equity, stay there for 5 years, and there's no way that you could have ever built that in many other circumstances, and certainly not at the ease that it's being able to offer to you at this with this program.
Yeah. All right.
And
Next
the
one.
market has shifted slightly as well, in the sense that we're not seeing as many of the multiple offers. So if you were in the market to purchase 2 and 3 years ago and felt like this is exhausting, I can't do this, the climate has changed, and you coming to the table with a healthy down payment as well, really a unique, unbelievable opportunity. Wiki Up Meadows, also in Santa Rosa, list price $825. Really nice established neighborhood that we've got there. Again, look at the size of the backyard. You've got a hot tub there, the kitchen that's been nicely upgraded, vaulted ceilings, walk right downtown we're right around the corner, and we've got Malsbury Market there and a coffee shop.
That's
Not
awesome.
too far from all the hospitals that we've got in Santa Rosa as well. Kaiser, Sutter are all very close to this property.
That's fantastic. So you guys can see there's plenty of opportunity out there, and these are all of a sudden houses that somebody wouldn't even be able to consider unless they qualify for this program. One great point that Erin brought up, Meagan. So rates, especially we had the Fed meeting today. They didn't officially say they're going to do it, but it sounds like we're looking at a September rate cut, maybe one in December. So as rates come down, when you have this $350,000 second, what's your possibility of refinancing that first mortgage with that in place?
That's a great question, FM. So refinances are available through the program. If you use the program and you decide to refinance at some point because interest rates improve, that's an opportunity, as long as it's done through US Bank, which is the servicer for this program. If your lender is not employed by US Bank, but they have a correspondent lending relationship with US Bank, which all of the participating lenders in this program do, they can refinance you. We also have another program called GSFA Platinum, which also provides down payment and closing cost assistance, which also allows for refinances. So if you wanted to refinance your home using the Platinum program and not having to come in with any money to close, you could use that program as well to refinance and resubordinate that second mortgage.
That's great. So you could either go US Bank retail, or we have US Bank as a correspondent, but we would have to use that product when we're doing the refinance.
You would have to use US Bank. It doesn't
Got it.
necessarily have to be the Platinum product, but as long as US Bank is the lender you're using to refinance, or even as you know, like you said, you're a correspondent lender, if you would use US Bank, sell that loan to US Bank, then that's absolutely
That's
allowed.
okay. Okay, awesome. So yeah, that's it. So what next? Well, you can either schedule a consultation. So if you want to just talk through your qualifications and not have to go through an application and everything, that's great. If you're ready to start an application, you can go to our website, fmzteam.com, fill out the application, then we can schedule some time on Zoom to go through, make sure that you're eligible, and see what the next steps are. Meagan, what's the verification process to make sure that somebody lived there 4 years ago? What kind of documentation would somebody have to provide with their address?
Yeah, that's a good question. So it depends. The basis of eligibility and determining that is going to be tax returns, right? That's what we're defaulting to. Also, we're going to use rental agreements, utility bills. You know, not everyone is going to have, tax returns available that are going to reflect that address. But as long as we have some kind of verifiable documentation that reflects that address and connects the buyer to it, then we'll accept that.
Okay. And another important point here is, especially for Erin, like all the people that you run into, you could have lived in Reading, or you could have lived in any one of the other counties that were affected and now want to buy in Sonoma because you relocated here a couple of years ago. You know, you basically, as long as you lived in one of the affected counties in one of those zones, you can buy anywhere in the state. You don't have to buy in one of the affected counties, correct?
Correct. And actually, FM, some of those counties, to your point, like Shasta or, Siskiyou, other counties are eligible in different years or both years. And so even if you lived in, say, Shasta County in 2018 and you relocated to Sonoma County a couple of years ago, you're eligible for the assistance. So you can purchase in Sonoma County now based on having lived in Shasta County in 2018 or 2020
That's
in
great.
an eligible area, of course.
That's great. And Erin, so you're at Sotheby's, just parked right there in downtown Sonoma, but you cover all of Napa, Santa Rosa, Sonoma, all that stuff, right?
Napa and Sonoma County.
Yeah,
And then I have connections throughout the state.
that's fantastic. And I've worked with Erin, and what I love about working with you is the care you take for your clients, almost like they become your family when you start working with people. So we definitely have the same core values when it comes to that type of stuff. So thank you guys. Big thank you to Meagan. I know you're busy with this and appreciate your time. Thank you, Erin, for jumping on here and walking us through the listings and everything. And if anybody has any questions, then feel free to reach out, and this will be recorded and put onto our channel. All right. Have a good night, everybody.
Thank you.